So in the first example, we just went over in the base case situation, we talked about usually if the fair value of an asset goes above its book value, companies cannot recognize any gain here. It is only when the fair value goes below its book value, the firm needs to recognize impairment loss. However, when there's an exchange of assets, firms can actually recognize a gain in this situation. So to preclude the possibility of a company exchanging appreciated asset just to recognize that gain, fair value can be used in gain situation that only have commercial. Fair value can be used only in the gain situation that have commercial substance. So this is to preclude companies from just to exchange appreciated asset just to recognize that gain. And what is commercial substance? Commercial substance is present when future cash flow change as a result of the exchange. So firms cannot just exchange asset without affecting its future cash flow and solely to recognize that gain here. So what do we do for gain situations that do not have commercial substance? There are two situations here. If in the situation of there's no cash exchange, or if it is cash paid, we do it the same as fair value. We view it the same as fair value, not determinable. Or in other words, we do not recognize any gain or loss here. And if there's cash received, so in the situation of cash received, we need to calculate whether or how much gain we recognize here. It depends on the ratio of cash received as a percentage of total received. And if the ratio is more than 25%, we recognize all of the gain. So we view it the same as it has commercial substance. However, if the ratio is less than 25%, we only recognize part of the gain. This may look complicated, but it's not that complicated. Let's go through what it means through two examples. The first example, company A traded a tract of land plus 500 cash for a similar tract of land. The old land has a book value of 2,500 and a fair value of 4,500. Assume the exchange do not have commercial substance. So if it does have commercial substance, it goes back to the base case situation. However, here we only care about what if it doesn't have commercial substance. So company A traded an old tract of land plus 500. So in this situation, A is giving out money for this exchange. So then we need to worry about, oh, what is your intention here? You are paying out money to do an exchange that does not affect your cash flow at all. So which doesn't have commercial substance. And you are giving out money to do this exchange. What is your intention? So here the intention is questionable, right? So in this situation, the company A cannot recognize any gain in this situation because your intention is questionable here. For a new tract of land, so the old tract of land has a book value of 2,500 and a fair value of 4,500. So even though your fair value is more than your book value, here because your future cash flow doesn't change, and you are giving up money, you are paying out cash to be in this exchange. So company A cannot recognize any gain or loss here. So the new equipment is valued at the book value of the new tract of land here is valued at the book value of the old tract of land plus whatever cash company A is giving out. So 2,500 plus 500. That is 3,000. This is how much the new piece of land should be valued at. And the journal entry here is to debit the new piece of land, 3,000, credit cash, 500 and credit the old tract of land 2,500, and there is no gain or loss in this situation. So this is the first example. And let's look at the second example. Company A traded a tract of land for a similar tract of land and received $500 cash. So now company A is receiving money. And then the old tract of land has a book value of 2,500, fair value of 5,000. So here it's a little bit different from the previous situation. In the previous situation, A is giving up, is paying B money and to be engaged in a transaction that does not change its cash flow. But here, company A is actually receiving money. So can you imagine that in the extreme situation, company A is receiving the whole 5,000 money back. It is like selling the old piece of land at 5,000. Of course, company A can recognize the difference, which is 2,500 as a gain for itself. So, but however, here it is kind of like a middle situation. It is only receiving 500. So here, because company A is receiving cash, its intention is a little bit not as questionable as the previous situation. So here we can, depending on what is this 500 as a percentage of the total value, which is 5,000, we can either recognize part of the gain or the whole difference as the gain. So let's first calculate the ratio here. So the ratio is it received 500 as a percentage of the total value of the transaction, 5,000. So that is 10%. So here this 10% is less than 25%, which means that we can only recognize part of the gain. So the gain can be recognized, 5,000. So the total like gain on this transaction, which is the difference between fair and book value, is 5,000 minus 2,500. So that is 2,500. And we only recognize 10% of that, which is 250. And to write out this journal entry, the firm gets an we need to first write out the firm is giving up an old piece of land. The book value is 2,500. The firm also received cash 500. And then the next thing we need to write out is the cost of the new equipment. That is actually something we put on there to balance this journal entry. So what else we have here? The firm can recognize a gain on the exchange, which is 250. And to balance this out, the cost of the new piece of land is 2,250. So as you can see here, that it is a little bit different from before, because this entry is the cost of the new land is the last thing we write out in this journal entry. This is just to balance this journal entry. So this is about the exchange of PP&E.